Hi, I'm Larry TABB, founder and CEO of TABB Group, and I'm here with Natan Tiefenbrun from Commercial Director of Turquoise. And I guess the question is, last week, the LSE was wonderful enough to have me come and talk to some of their clients, and in one of the presentations that I didn't do, there was a discussion really around equity turnover within different markets. And the thing that was really interesting was that it seems like if you aggregate the European equity market cap, it only turns over like 85 or 87%, I forget the exact number, a year, so less than one time. And if you look at that same comparison to the U.S. turns over something like 2.5 or 2.7 times a year. So the market cap turns over 3-4 times as much in the U.S. than it does in Europe, giving Europe certainly a lot of opportunity to grow. I guess the question, Natan, is do we see the European turnover of equities increasing over a period of time? Do we think we'll get more competitive? And what are the things that we will need to happen in Europe to get the turnover velocity higher in Europe?
So firstly, yes, I think we are already seeing trading velocity increase. So the proportion of the market cap that turns over each day is growing. And I think all the participants in the market are anticipating further strong growth there. Mm-hmm. And the answer is simply, is competition through all parts of the value chain. So Europe is an incredibly inefficient, difficult, expensive place for most people to trade. Mm-hmm. So there are more than 20 trading venues, and there's almost as many clearing houses, and there's one depository for securities in every country. So unlike the US market, and looking at equities for starters, mm-hmm. Where you have a single clearing corporation and depository, right. You have this fragmentation in Europe, which means that market participants bear the cost for all of that infrastructure. Mm-hmm. And that cost shows up whether it's in trading tariff, which was historically true, although I think trading tariffs have now come down very dramatically due to competition. But it's also true in clearing tariffs, in the cost of settlement in the depositories, in the cost of connectivity to all those venues, in the cost of complying with the different regulations of all of those venues. Mm-hmm. So that fragmentation, that national alignment of the infrastructure imposes a cost and complexity on all market participants. So the answer, of course, is therefore competition and ultimately consolidation. Mm-hmm. And that's true not just for equities, but I think we also have to look into other asset classes. So I believe it's a very substantial part of US equity volume is driven by the fact that you also have competitive options trading, for example. Right. Mm-hmm. And again, in Europe, we don't have that competition in that space also. So the answer is clearly increased competition to drive efficiencies and to drive consolidation. But I think there are many obstacles, and we've come a long way in 2.5 odd years. Right. We have so much further to go.
Mm-hmm. Do you think, we have certainly MiFID has opened up the landscape tremendously, and pre-MiFID there were a number of folks that tried to create alternative venues that failed. Now we finally seen the first European alternative venue succeed, including Turquoise and Chi-X and other players. That's the first start. Do you think we wind up getting the clearing? First of all, I guess are we going to see these alternatives grow and challenge in the main markets? I guess that's the first, and then the second, I guess if you look at the clearing side, it just seems overwhelmingly difficult to get everybody to interoperate. Do you think that we wind up getting an interoperative model, or do we wind up with somebody coming in with a new out-of-the-box idea that all of a sudden has the right economics and everything clicks into place, or is it a combination?
I think that's a great and very timely question. The project for CCP interoperability has been ongoing for 2 years. So what that means is that trading participants would, on a single trading venue, be able to choose from more than one clearinghouse. Right. Mm-hmm. And the advantage being that a participant who trades in 10 venues could say, well, I'm going to use one clearinghouse across all of those 10, mm-hmm. and therefore get very significant margin savings, efficiencies. And the regulators are, of course, very reasonably are worried about systematic risk of one clearinghouse failing and dragging down another.
Right.
And so they're imposing additional capital requirements that the clearinghouses have to post margin with one another. And I think part of the unfortunate effect that that's having is that the promised margin efficiencies will fail to materialize. So I would say that as a market operator, LSE Group and Turquoise, I think we look at interoperability and this whole project and not only deeply frustrated that it has taken so long, but equally disappointed that as we seem to be approaching the finishing line, that so many of the benefits have proved to be elusive. I think the clearinghouses have reduced their cost per trade over the last 2 years, but average trade sizes have also fallen dramatically. So ironically, when you look at actually in basis point terms, the cost of clearing has really not moved very substantially over the last couple of years. So trading tariffs have come down, 50, 60, 70%, even 90% in some venues, and yet the cost of clearing in basis point terms have not really moved substantially. So I think there's frustration with just how quickly interoperability will arrive and what benefits it will ultimately deliver. And NYSE Euronext, I guess, just over 2 or 3 weeks ago, announced, in fact, that rather than continue to use LCH, which as a clearinghouse has been very supportive of interoperability, they've announced that they're going to abandon LCH and ClearNet and create their own new vertically integrated, hermetically sealed, clearing infrastructure to service their markets. And I think that the fact that some market participants seem happy to let them do that. Obviously they've been promised that if we do it this way, we promise the cost will be lower.
But that'll be lower maybe in Euronext, but then will it be lower in Turquoise when they trade Euronext stocks?
Or lower for the market in aggregate. So I guess the fact that NYSE felt they could announce what to me seems like essentially an anti-competitive strategy, it just shows how much frustration there is with market participants, and they're just looking for anything that shows promise of lower cost.
Interesting.
At Turquoise and the LSE Group, I think we still believe that competition and user choice of clearer is more likely to drive the correct outcome.
Now, I guess initially, if you go back a couple of years ago, you had EMCF and EuroCCP kind of come in, which looked almost like clearing model type. One was connected to Citi and one was connected to, I guess, Fortis, and they would act kind of as clearing hubs because they were already connected into all the depositories. And then you had Fortis have challenges through the credit crisis, and EuroCCP, probably hasn't been as successful as they would have liked. So are people abandoning that kind of model, or are we still kind of up in the air?
I don't think EuroCCP have been unsuccessful in the sense that they've been Turquoise's clearer since inception. They have a very aggressive tariff schedule. Of course, EuroCCP is the European arm of DTCC.
Right.
And for us, one of the great advantages of having worked with EuroCCP is that we're now launching US equity trading in a European environment, which we couldn't do with any other CCP. But the fact that there's been no interoperability means that EuroCCP has not been able to approach their customers, whether Goldman Sachs or Merrill Lynch or UBS, and say, hey, use me in all these markets. So they've ultimately been stuck clearing only for Turquoise and a number of other smaller platforms. EMCF was chosen by Chi-X and then subsequently also chosen by BATS, and those are, there was other both big pan-European MTFs. But equally, they haven't been able to break into the LSE or Deutsche Börse. So, it's the lack of interoperability has essentially limited the ambition of those clearinghouses to offer their services more broadly. So, hopefully, interoperability of sorts will create some competition. I think ultimately, we've got too many clearinghouses in Europe.
We don't need more.
We don't need more. We have a number of pan-European players, EuroCCP, EMCF. We've obviously got others who aspire to becoming pan-European, and LSE Group owns CC&G in Italy, and Deutsche Börse has Eurex Clearing, which it wants to expand internationally. There will likely have to be some consolidation there also eventually. But I think we need competition first. We want to see the prices driven down. I think the big question around clearing organizations is what is the governance model and what is the ownership structure. So even more so than perhaps with trading venues, which are relatively commoditized, because clearing is ultimately about managing risk, a lot of attention is paid to that governance model. And I think that a lot of participants look at all the players out there and find them all wanting either they're big incumbents with hugely inefficient technology, which I guess is how NYSE Euronext views LCH ClearNet, or they're nimble startups like EMCF, but that perhaps people aren't confident that they can scale and provide quality of service, or they're very good at what they do. For example, CCG in Italy, but people aren't sure whether they can really internationalize and serve a pan-European audience. So I think there's a tremendous amount to play for in that space. As a trading venue, what we want to do is offer our members choice. We want to reduce the cost of trading, because when we do that, trading volume, and I guess that's what you asked at the beginning, trading volumes can explode much further. And
have a wider turnover,
greater
opportunity,
grow the market and encourage volume. And I think, for us, quite timely actually. I don't know if you saw this morning, LSE Group CEO Xavier Rollet announced that we're actually also going to launch derivatives trading on a pan-European basis.
Right.
And of course, that's all about clearing.
Right.
So and again, to try and offer participants margin efficiencies across both equities and equity derivatives. Again, we deliver tremendous advantages and encourage more volume. So I would say that with the MiFID review, we're trying to tidy up the trading rules, the trading infrastructure. We're beginning to see consolidation there. NASDAQ Europe has exited the market for trading.
Right.
I think the next 15 to 18 months are probably the main game in clearing is afoot.
Interesting. With that, I think we'll close it down. Again, Natan Tiefenbrun, Commercial Director for Turquoise, Larry TABB, Founder and CEO of TABB Group, and want to thank you for joining us.
Thank you.